Okay, we've been through the process of the consolidation at the date of acquisition. Now let's go ahead and see what happens in the first years subsequent. Let's go ahead and work with the same example we had previously. Let's assume that big company acquires 100% of the voting stock of little company on January 1st, 01 for $300,000 cash. On that date, little company had a book value, again that's net assets or owner's equity of $300,000, and all of their assets and liabilities had fair values equal to book value. Now let's go ahead and assume that at the end of the year, Little reports earnings of $50,000 and declares and pays dividends of $20,000. First, let's go ahead and go through our equity method entries to account for our investment. Again, these are on the books of big company. First, they record their acquisition, so they debit investment in Little for $300,000, credit cash for $300,000. Next, they report their share of the investee's income. This is a wholly owned subsidiary. We own 100% of Little's stock, so we, in a sense, own 100% of Little's income. So we recorded investment income of $50,000, and that increases our investment in Little. Third and finally, we have the dividends paid by Little. Again, we are the sole shareholder, so we receive all $20,000 in dividends, and that reduces our investment in Little. Just to sort of get our bearings here, our ending balances, the investment in Little is $330,000. That's our beginning balance of $300,000 plus our share of the earnings less our share of the dividends. And the investment income is $50,000. Now, this is going to be a worksheet format that we're going to make a great deal of use of. It's referred to as the 5-column or 3-part worksheet. Again, 5 columns of numbers plus a 6th column with the account titles. And the 3 parts, we have basically the 3 financial statements here. The upper third is the income statement, the middle third is the statement of retained earnings, the bottom third or so is the balance sheet. Now, this is just the trial balance of each company organized in a very specific way. Again, every number on there for each of the 2 columns, big column and little column, that is simply the trial balance that's been rearranged. Rather than having assets versus liabilities and equity, we've organized it into its 3 sort of financial statement categories: income statement, statement of retained earnings, and balance sheet. Again, the income statement is at the top, the statement of retained earnings is in the middle, and the balance sheet is at the bottom. And again, I can't stress enough, this is nothing more or less than the trial balance forced into this new template. Now, let's go ahead and see how the numbers fit in here. I've put in bold here the investment income, which, again, that was the result of our equity method entries reporting our share of Little's income. And we have our investment in Little with the balance of $330,000. Also note that the retained earnings balance on the trial balance, the retained earnings figure is the beginning of period retained earnings. Once we go through the closing process, closing out our revenues and expenses and dividends to retained earnings, then we'll have the ending balance of retained earnings. But at the moment, the numbers in the trial balance, $460,000 for big, $200,000 for Little, are the beginning retained earnings figure. The ending retained earnings, down at the bottom of the balance sheet, that number is, as of yet, unknown. It hasn't been recorded yet or computed yet. Now, let's go ahead and work through the worksheet for the big and little columns. I think we're going to basically work our way down from top to bottom. So first we go ahead and run through the income statement. For big company, we have $400,000 in sales, less $300,000 in expenses, plus $50,000 of investment income for income of $150,000. Likewise for Little, sales of $300,000, less expenses of $250,000, equaling income of $50,000. We take those income figures and transfer that down to the statement of retained earnings. So now in our statement of retained earnings, again, we're going to work our way down. For big company, we have beginning retained earnings of $460,000 plus the income less the dividends equals ending retained earnings of 580,000. Likewise for little, beginning retained earnings of 200,000 plus income of 50,000 less dividends of 20,000 equals ending retained earnings of 230,000. We take the ending retained earnings figures and transfer those down to the balance sheet as ending retained earnings. So now we've completed the worksheet columns for big and little. We now have a completed income statement, a completed statement of retained earnings, and a completed balance sheet. And it's always a nice touch just to confirm that the balance sheet does in fact balance. So for big company, we have total assets. We have a $330,000 investment in little, $640,000 in other assets for a total of $970,000. On the credit side, 240 plus 150 plus 580, $970,000. And likewise for little, the total assets of 460 equal the total liabilities and equity of 460,000 as well. Now let's go ahead and look at the investment in little account for a moment. Again, I mentioned this earlier. The end of year balance is $330,000. That's comprised of the beginning balance of $300,000. We added the $50,000 of investment income. We took away the $20,000 of dividends received, and so we have an ending balance of $330,000. Now, in the consolidation process, that investment in little account has to go to zero. We can't have an asset as an investment in ourselves on our consolidated balance sheet. So that account has to go to zero. Now, if you were to look at a half dozen or a dozen different advanced financial accounting books, you'd see a dozen different ways of organizing the elimination process. They all get you to the same place, but they would just be organized in the elimination entries would be organized in a different fashion. Now we can eliminate that investment in little account in one fell swoop with a single $330,000 credit, or we can eliminate it in steps, in sequence. And that's the approach that most people take, and that's the approach that we're going to follow as well. Now, our elimination entries are going to start getting a little bit more involved here. Again, different people will organize this in different fashions. We could do all of the elimination entries in one big journal entry. Alternatively, we could break it down into sort of bite-sized steps, which might make the process be a little bit more intuitive, trying to explain exactly what it is that we're doing. And again, we're going to need to eliminate our investment in little account as well as little's equity accounts. We're also going to need to eliminate our investment income. Since we're viewing big and little as a single economic entity, it wouldn't make sense for us to have an income statement account essentially representing income from investing in ourselves. We also need to eliminate little's dividends. The consolidated financial statements should reflect the transactions or relationships with external economic entities. Little's dividends were paid to big. It's essentially like taking money out of our left-hand pocket and putting it into our right-hand pocket. And you're looking at that dividends line right smack in the middle of the worksheet. We see that big paid $30,000, little paid $20,000. In terms of dividends paid to external economic entities, only Big's dividends were paid to external parties. They were paid to Big's shareholders. The $20,000 that Little paid was simply paid to Big. It was paid to a related party. So let's go ahead and go through our elimination entries. Again, I'll keep saying this. Different people organize this work in different fashions. I organize it in the way that I think is best, obviously. The textbook takes a different approach, and a little bit later on we'll sort of reconcile the two and try to see how they relate to each other. Again, I like to do this in bite-sized pieces. So first we have our S entry, and this is exactly the same as it was in the consolidation at date of acquisition. Basically, we're going to take our beginning of year subsidiary equity accounts. The beginning of year common stock is 100,000. The beginning of year retained earnings is 200,000. Again, note there are two retained earnings numbers for little. There's beginning retained earnings of 200,000. There's ending retained earnings of 230,000. We eliminate the beginning of year retained earnings balance. And we close that against our beginning of year investment in little. At the beginning of this process, the investment in little account had a balance of $300,000, our initial acquisition cost. Next, we're going to have, later on, not in this case, but later on we're going to have an A for amortization entry. Now again, that's not applicable in this case. I just wanted to put it in here just so we can start developing our little acronym that'll help us to remember these things. Next, we're going to have the I for investment income entry. Again, looking at the worksheet, we see up in Big's income statement, they've got this investment income number of $50,000. That has to go away. We can't have on the consolidated income statement income from investing in ourselves. So the investment income is a $50,000 credit. If that's positive income, it's a credit. And so we're going to eliminate it by debiting investment income. And we credit the investment in little account. Next we have the D for dividends entry. Again, right smack in the middle of the worksheet, that dividends line, dividends declared is a debit balance. It reduces owner's equity. So to eliminate little's $20,000 in dividends declared, we're going to credit dividends or dividends declared for $20,000 and debit the investment in little. Now before we go any further, again, think of, look at that investment in little balance on the worksheet of $330,000. Again, that was our beginning balance of $300,000 plus $50,000 in income minus $20,000 in dividends. And we've eliminated that $330,000 in those same exact steps. First, we eliminated the beginning balance of $300,000. Then we eliminated the $50,000 increase from the earnings. Then we eliminated the $20,000 decrease from the dividends that were received. Now it's time to start posting this stuff to the worksheet. Now, it should be the case that the hard part of this is actually preparing the elimination entries, the journal entries. Once you prepare the journal entries, this is all strictly a mechanical process. It should be not easy, not trivial, but it should all be, you should be coasting downhill from this point on. So we have our 3 elimination entries. In all 3 entries, debits equal credits. It should be, at this stage of your careers, it should be virtually impossible for you to record a journal entry that doesn't balance. So we have 3 journal entries. All of them have debits equaling credits. And now we're going to take the debits and post them to the debit column and the credits and post them to the credit column. Again, a simple mechanical process. The only rub is going to be making sure you post the credit or debit, as the case may be, in the proper row. So let's just run through this one by one. First, we debit common stock. So down in the owner's equity section of the balance sheet, we put a $100,000 debit by the common stock account. Next, we post the $200,000 debit to retained earnings. This is a common place for people to get tripped up at first. Again, in that elimination entry, we were debiting the amount of beginning retained earnings. So we're going to adjust beginning retained earnings on the worksheet. We never adjust ending retained earnings. We always adjust beginning retained earnings and then let those adjustments sort of flow through to ending retained earnings as we work through the worksheet for the consolidated column. And then third, we credit the investment in little for $300,000. And again, you'll note that I'm putting little S's by these entries in the columns, again, to indicate which entry these various numbers came from. Next, we post the I entry, $50,000 debit to investment income up in the income statement, a $50,000 credit to the investment in little down in the balance sheet. For some reason, this entry gives some people a lot of trouble. This should be the easiest elimination entry of them all. Basically, we look at Big's income statement and we say, oh, look, they have $50,000 of investment income. That has to be eliminated. So we eliminate $50,000 of investment income. We don't have to do any calculations. We simply eliminate whatever is reported as their investment income. Next, we post the D entry, a $20,000 debit to the investment in little and a $20,000 credit to dividends declared in the statement of retained earnings. And again, at this point, it's a good idea to go ahead and foot those two columns. So the total debits, 50 plus 200 is 250, plus 20 is 270, plus 100 is 370,000. On the credit side, $20,000 plus $300,000 plus $50,000, totaling $370,000. And lest you think this is trivial, when I first made up this example, I mistakenly put a $100,000 debit to retained earnings as opposed to a $200,000 debit. And so when I footed these columns, the totals didn't match. I had $270,000 in the debit column, $370,000 in the credit column. I knew I had done something horribly wrong. So you go back through and check, and again, this is where the letters by the numbers comes in handy. I went back through and checked. I said, okay, did I post the S entry correctly? And I realized, nope, I screwed that one up. And so I could catch my mistake fairly quickly. If I hadn't taken the time to foot those two columns, confirming that total debits equal total credits, it was, it's conceivable I could have gone through the entire process and ended up with an incorrect answer. So it's a useful thing to do. It takes all of 45 seconds to add up the columns. So please take the time to do that. Okay, now we start working our way down the consolidated column, filling out this worksheet. Again, this is all now a mechanical process, simply applying the debit and credit rules as we add across each row and keeping in mind a few things that I'll mention as we get there. So, adding across the sales row, $400,000 for big plus $300,000 for little with no adjustments, so the total is $700,000. Likewise with our expenses, $300,000 for big, $250,000 for little with no adjustments for a total of $550,000. And then we get to the investment income, and again, big's $50,000 of investment income being a positive income number would be a credit. We offset that or cancel that or negate that with a $50,000 debit, and the investment income goes to zero. Again, that is a reliable check figure. That number has to go to zero. If we add across that row and we don't find it going to zero, then we've made a mistake. When we get to the income figure, we're going to go ahead and work our way down the income statement column under the consolidated heading. So we have $700,000 in sales, less $550,000 in expenses, equaling income of $150,000. Now I can't stress this enough. When we come to a subtotal or a calculation like that, whether it's computing income or whether it's computing any retained earnings, we stop adding across the rows and instead work our way down the consolidated column. If we were to add across the income, we'd have $150,000 for big plus $50,000 for little, which would total to $200,000, and that's incorrect. Basically, little's income of $50,000 would be double counted. Not only is the $50,000 in little's column, it's also included in big's income of $150,000. So again, when we come to a subtotal, whether it's net income or cost of goods sold or any sort of subtotal, any sort of calculation like that, we always work our way down the column rather than working our way across the row. Okay, just as we did for the big and little columns individually, once we compute the income for the consolidated entity, we immediately transfer it down to the statement of retained earnings. And now we can go ahead and work through our statement of retained earnings. Beginning retained earnings, again, we've eliminated the subsidiary's beginning retained earnings with that $200,000 debit, and so we're left with the parent's beginning retained earnings of $460,000. We add in the income we've already put in the cell there. Dividends, again, we've eliminated the subsidiary's dividends, so we're left only with the parent's dividends. And so again, working our way down that consolidated column, our ending retained earnings is $580,000. Beginning retained earnings of $460,000 plus net income of $150,000 less dividends of $30,000 equaling ending retained earnings of $580,000. Again, if we had added across ending retained earnings, we'd have $580,000 plus $230,000 is $810,000, which is obviously incorrect. So again, anytime we're getting a subtotal or a total, we always work our way down the consolidated column. Once we compute ending consolidated retained earnings, we immediately transfer that down to the balance sheet as ending retained earnings. I stress doing that immediately because there's a real risk that, again, in this case, I've aggregated all of the assets into a single other assets amount, and I've aggregated all the liabilities into a single liabilities number. But if we had a more extensive balance sheet there, we might sort of find ourselves, sort of on a roll, just adding across each row, add across a row, add across a row, add across a row, and so on. And we might get so caught up in it that we'd simply add across retained earnings also without thinking about it. So by moving that ending retained earnings number down right away, we're populating that cell. We're putting a number in that cell of the worksheet, which will sort of stop us before we do something silly like adding across the retained earnings row. Anyway, continuing, the investment in little account closes out to zero again. We have $330,000 in Big's investment in little, and that's being offset by a $20,000 debit and $350,000 in credits. So again, that nets out to zero. That's a very useful check figure. If that doesn't net out to zero, then something's wrong. You have to stop and go back and figure out what went wrong. Our other assets, we simply add across. $640,000 plus $460,000 with no adjustments is $1.1 million. Likewise with our liabilities, $240 plus $130 is $370. And then for our common stock account, again, we've eliminated Little's common stock with that $100,000 debit, and so we're left solely with Big's common stock of $150,000.